Hi everyone, good morning again. I can see that we've just had a question asked about presentation slides. Yes, they will be circulated, so don't worry about those. Just to get us going, good morning everybody. Welcome to the third in a series of 8 accredited CPD courses taking place this year and brought to you by the K3 Hub and Tolly. My name is Marie Wadeson. I am a managing director here at Quantuma, and on behalf of our parent company, the K3 Capital Group, I am also responsible for the K3 Hub, which is a network of, it's a member network for professional advisors developed by us and our fellow group companies within the K3 Capital Group. Since we launched earlier in this year, over 1,500 like-minded members have joined us, and through the hub, our members can access a range of CPD and training sessions, not dissimilar to today's event, and also referral fees for certain types of work referred into our group. Okay, moving on to today's session, Ros Martin. I'm delighted to welcome Ros today. Ros is our trainer, and today we're here to talk about all things succession planning in OMBs. Today's session is broadly going to cover CGT and IHT issues when transferring a business to family members, the issues and pitfalls of passing the business to employees, restructuring the business to facilitate succession, preparing a business for sale where no obvious successor exists, and everybody's favourite, interacting with their HMRC. Q&A function is open, and Ros is available to answer your questions as we go through. She'll pick those up at the most appropriate time. And as you can see, the chat function is live. So just before we get on our way, a very quick thank you to Ros and to Tolly for today's training session. And most importantly, thank you to you all for joining us. I hope that you enjoy today's session. And without further ado, over to you, Ros.
Thank you very much, and good morning. Yes, just to reiterate, if you do have any questions, please feel free to put them in the Q&A box and I will deal with them as I can. Somebody's asked whether there are notes available, and yes, notes and slides will be circulated after the session. So I think that the starting point really with succession planning is that it's not straightforward, and actually it's often not a linear process. By that, I mean that clients will come in, they will say, we want to talk about succession planning, but actually what they really want to do is to just chew the fat as to what the possibilities might be. It's often a process whereby you will start to explore things and effectively realise that it's not going to work and change tack a little bit. It is one of those things where it is not necessarily very straightforward. And so in some ways it's very interesting work, but can be frustrating, and clients and managing clients are also, as always, as we know, managing clients is not always straightforward. So there's lots of different avenues you can think about. It's quite difficult to be generic because different clients will have different needs. And so really we're just going to go through in a fairly sort of hopefully logical manner, but just kind of think about, you know, what might be the things that we're talking about. And as I said, I think that Marie has just kind of gone through what we're going to be talking about really. First thing you want to identify is whether there is the possibility of succession within a family, and then you would be looking at whether or not you're going to transfer in lifetime or on death. Do we need to actually get value out of the business? Are there any capacity issues with the people that you want to pass on to? Are there going to be people who aren't going to be involved? Therefore, we need to think about a bit of peripheral IHT planning as well. If there's no obvious successor within the family, is there any possibility that you can transfer to the employees? Are we looking at something like an MBO, management buyout? Or might you even want to go down a slightly more sophisticated route, which is to look at something like an employee shareholder trust? And then I suppose if none of those are going to be relevant, then how can we prepare the business for sale or for winding up? To a certain extent, selling and winding up is not really succession planning, though obviously there is succession, just not you. But I will just touch on that briefly at the end because it does cover some interesting points as well. Okay, so we'll start off by thinking that we're going to pass on to the family. I suppose this is one of the areas where business has just changed dramatically over the last sort of 100 years. I appreciate that's a very wide window that we are looking at. But effectively, it's not always as easy as it used to be to pass the business on to the next generation. There are, I think that at one stage it was always assumed that there would be an heir and it would do that, you would pass on to the next generation. The first point that we often find when we're talking about passing on to the next generation is that the parents or the grandparents become very reluctant to give away control, because they are very worried about the fact that they are going to give their business away to the next generation, and then the next generation are not going to run it properly. But we need to start somewhere, and that is a conversation that we will need to have. Now, obviously, that does assume that there is somebody in the next generation who is actually willing to take on the business. And again, that is not necessarily going to be the case. Different people may well have different ideas about what they want to do with their lives. So, you know, giving away to the next generation is not always going to be straightforward. The other thing that you find, of course, is that the next generation wants to take over the business, but they don't want to do it the same as you, and that also causes tension. I always think that when you start to talk about succession planning and IHT planning and so on with families, it becomes a little bit of social work as well as tax planning as well, because you often have to referee a little bit between different sides of the family. And I also do think, on a slightly more serious point, that there are issues with conflict of interest as well. If you are planning something, it may well be quite important to make sure that both sides do get independent advice, that you're not necessarily advising both sides of the equation. So as I've said already, if we're talking about passing on to family members, there is a tension between, do we give away in lifetime or do we give away on death? Giving away in lifetime is going to be relatively straightforward in certain circumstances, but not always straightforward. If you are thinking about gifting assets to the next generation, and those assets are business assets, then we are looking at holdover relief. Now, when we're talking about gifts in this context, it would also apply to a transfer at under value. So it might well be that you want to transfer the property or the shares or the business to the next generation. You're going to charge them something for it. So you might look to get some money back, and we will come back to this point later on when we talk about what happens if you actually do need to get some money. As the departing business person, you do need to get some money out of the business in the first place. So normally, if you've got a gift, whether between connected parties or unconnected parties, the starting point is that you calculate the gain by reference to the market value, but then the gain can be held over. Now, it's a joint claim, so both parties, both the transferor and the transferee, have to sign the claim. If it was going into trust, and we'll talk about trusts in a moment, if it was going into trust, actually just the transferor has to sign the claim, but that is a slightly different issue. So the transferee effectively assumes a lower base cost. So the gain is effectively held over into the base cost of the shares, which will mean that you are going to crystallize a larger gain in the future. Normally, we would work on the basis that actually you're not going to crystallize a gain now because it's a dry tax charge, because you're not getting any money for it. But there might be circumstances where actually the first generation or the retiring generation actually do want to sell for full value or close to full value to their children. and then we would be looking at the availability of business asset disposal relief. And again, I'm going to touch on that at the end of this morning's session. And going on to that point, just considering that point generally about whether or not you might want to sell to the next generation, I'm doing some succession planning at the moment with a family where the parents are adamant that if the children want to take over the business, they've just got to buy it off them. And they're not really bothered about trying to sugarcoat it with them. So that's quite an interesting conversation that we're having. So what falls under the umbrella of a business asset? Because obviously, if we're saying that you get gift relief on a business asset, then we need to know what a business asset is. So 2 categories. We'll start with the second one, actually, and that is shares or securities in a trading company, as long as it is an unquoted trading company and it is the personal company of the person who is making the transfer. And we'll look at those conditions in a moment. So probably when we're talking about succession planning, we will often be talking about shares in trading companies. Maybe there are situations where that is not the case. The other situation that we've got is any asset used for the purposes of a trade carried on by a transferor or his personal company, or a trading company of which the holding company is a personal company. So that covers unincorporated businesses. So any capital asset that is used for the purposes of a trade carried on by the transferor, either solely or in partnership, or indeed if you have an asset outside of a company. For example, if you've got the business premises that are sitting outside the company, perhaps getting an income stream from the company used for the purposes of that individual's personal company. Personal company is any company in which the transferor holds not less than 5% of the voting rights. And that is, clearly something that you would need to just check. No automatic attribution of rights of associates. So again, you do have to be slightly careful. Just looking at that particular point and going back to the point that I made earlier on about having business premises outside of the company, you do have to be a little bit careful because sometimes clients will throw in a little bit of a curveball. So for example, they might say, well, we've got our shares in the company, we've also got the business premises. What we want to do is transfer the shares in the company to our kids, for example, or our siblings or whatever. But actually, we're going to keep the business premises outside in our own names because we can then get an income stream. We can get rent, which will fund our retirement. So they give all of the shares away to the kids. That company is then not their personal company. So if they come in 2 years later or however long later and say, actually, we've decided now, for whatever reason, that we want to transfer that business premises to our kids as well, that property is not now used for the personal company of the transferor, and therefore it's not their personal company. Now, obviously, in that situation, what you might suggest to the client is that actually they gift 95% of the shares to their kids, and they retain 5% of the shares in the company, or indeed even a higher figure of shares in the company. And then it remains their personal company. But that would be one of the things that you would need to think about. So the definition of a trading company is the definition that we are familiar with for very many purposes, but the main one being business asset disposal relief. So it has to be a company which is wholly trading other than any activities that are not capable of being substantial. And in this context, HMRC consider that is 20%. And actually, we had a question in advance submitted by one of the delegates, which I'm pleased to say I can now shoehorn into the presentation quite early on. And it basically says, I have a construction company where the father owns 96% of the shares and the son, who now runs the business, 4%. The father wants to give the son a further 71% and claim holdover relief. The company nearly failed around 12 years ago when it had heavy losses, and ever since the father has built up cash reserves to ensure survival should the same thing happen again. Approximately 50% of the company's net asset value is in unmanaged bank deposits, though that amounts to some millions in terms of pounds. Could HMRC try to use the large deposits to refuse holdover relief on the grounds that it makes the company an investment company, or are we safe because the funds are unmanaged? And that is an interesting question. It's also, even though it is superficially a very straightforward, quite a difficult one to answer. Because if you look in the revenues manuals, they very clearly state that cash accumulation can be prejudicial to the trading company status for both holdover relief and BADR relief. If that is the case, even though that is the case, they have been very, very reluctant in the past to take the point. I'm not aware of there being any substantive case, for example, that has gone to the first tier tribunal on this particular point of cash accumulation. And from a very practical perspective, the only scenarios where I have seen HMRC challenge cash within companies is where you have effectively got an IR35 type company where there are absolutely no reserves. There's nothing in the company except a lump of cash, because any goodwill is probably personal goodwill. There's no substantive assets and so on. I have never seen the revenue challenge this point where you've kind of got what I might describe as a proper company. Now, what I might be tempted to, so I apologise to an extent that I can't really answer that question very substantively. I think what I might be tempted to do in that situation is actually transfer a few shares, put it on the dad's tax return, put a note in the white space to draw attention to the revenue that you've done this claim, and see if you get a challenge. Obviously, that's not ideal, but again, that might be somewhere to go. Or you could actually write to the non-statutory clearance section asking for clearance from the revenue that this is a trading company. Now, I would have to say that there is a risk in doing that, because if you go for non-statutory clearance and the revenue say, no, this is not a trading company, you can't then do the holdover claim without actually disclosing on the tax return that this goes against what HMRC have given clearance on. So that point is not straightforward. So it is quite a difficult question really to answer. Yes, if you want to discuss that point further, the person who sent the question in, if you just contact the people at Quantuma, they will pass your contact details on to me, and I can talk to you about that further. But it is a very interesting question, so thank you for that. Okay, so one of the things that we've got to be very aware of, that trading is normal trading, doesn't cover property investment, though it does cover furnished holiday let properties. So that is the case, and as I have already noted and talked about at some length, there can be issues arising with things like cash accumulation when we have BADR, so that is something that we do need to be aware of. From a very practical perspective, this is something that you do have to claim. The claim has to be made within 4 years of the end of the tax year. And there is a help sheet on the Revenue's website, the HS295, which goes through holdover relief claims and also includes a claim form which you can print off and complete and then attach as a PDF when you submit your tax return. Now, as I said, when I was talking a couple of slides ago about the mechanism of the way that this works, you have to calculate the gain and then you are effectively holding over the gain. And so theoretically, you have got to value the company. But the claim form, the HS295 claim form, also includes a facility where you can basically say, can we defer the formal valuation? Because actually getting a formal valuation is a little bit of a waste of money for everybody, both you and HMRC, unless they're actually going to reject the holdover relief claim, which is not something that we see very often. You do have to put a valuation on the form because you have to submit a pro forma CGT computation. But HMRC or indeed yourselves are not going to be bound by any valuation that gets put on it. But as I say, you do still have to compute the gain. The one thing to note is that if you defer the formal valuation, HMRC's view is that you cannot then withdraw the claim. There's no statutory basis for this whatsoever, but just to be aware that that is the view that they take. Now, there are some circumstances where holdover relief is restricted. The first is that if the recipient is not resident. So you can't get holdover relief at all, basically, if the recipient is not resident. And there is also a clawback of the relief if they cease to be UK resident within 6 years. So if you're transferring shares or you're transferring a business to somebody with whom you have, sorry, doesn't matter who you're transferring it to. If they cease to be UK resident within 6 years, then there is going to be an issue. There are different rules in relation to where you've got companies that have got UK land, because of the fact, of course, non-residents are subject to tax on UK land. So that can be quite a complex situation. I'm not going to go into that now, just to let you know that that is the case. Holdover relief might be restricted if you actually get paid for your transfer. And there is an example in your notes as to how that works. And the notes, I think, have either been circulated or will be circulated. There's also a restriction where you have a UK resident company. So if, for example, you transfer assets to a UK resident company, but that company is under the control of non-residents. And then the one that people often remember from when they did their training is that where you gift shares in a company and there are non-business assets. Now, it's quite important to note that non-business assets are that's not the same as non-trading assets. So, for example, if you had a company that had a trade in it, but then it had one, say, small rental property, and I say small rental property because, of course, it's got to be less than 20% of the total value so that you don't prejudice the trading company status of the overall company. That is a non-trading asset, but it's not a non-business asset because you have a property business. So it would really only cover private assets. So if you've got a chalet in there that the main director uses for skiing or something like that, and that is the situation. Now, when you're doing that restriction, you've got to use the market value of assets, and also you've got to remember to use goodwill. So again, it's just a reminder that's there. So that's shares. If you're talking about assets, so if you're talking about you have an unincorporated business or you have assets that are being used for the purposes of your trade, then if there are any periods of non-qualifying use or any non-qualifying uses of an asset. So if you had a shop with a flat over it, for example, then there would be a restriction on holdover relief. So again, that's just something that you need to think about. Question that has been asked, what method of valuation would you recommend? I must admit, I'm not a valuer. I always think valuation is a bit of a dark art, really. But there's no reason why any particular method of valuation should be used. So, if you're looking at, the kind of the standard multiple of the super profits within a company, that is probably going to be, fairly straightforward. But you certainly, need to come up with a, some kind of valuation. But if you are, normally valuing property businesses for clients, that should be sufficient. And I say, I apologise, valuation is one of the few, valuations and VAT are the two areas of tax that I don't tend to get involved in. Okay, there is quite an interesting extension to holdover relief, which is available where a property qualifies for agricultural property relief, but is not a trading asset. So anyone who's familiar with agricultural property relief will know that rented agricultural property qualifies for APR. There's a slightly longer holding period. So you have to have rented the property out for 7 years to qualify, rather than the 2 years when it's used personally. But rented agricultural property does qualify for APR. And so if you have rented agricultural property, then you can transfer that and get holdover relief. And that's certainly something that is used quite extensively within farming. Now, the other thing that anyone who is familiar with APR will know is that APR only covers the agricultural value of land, and any amount above that can be subject to inheritance tax. But the extension for holdover relief purposes actually also covers the non-agricultural value. So basically, the way the legislation is formulated states that as long as the asset qualifies for some APR, then holdover relief is available. Now, there's also another very, very interesting sort of tweak to the holdover relief provisions, because when you have the bit of the legislation which qualifies for APR, you don't actually have apportionment where part of what you are transferring is a non-qualifying asset. So let's just give you an example of how this works quite well. So I have a client, one of my main private clients. I don't have very many private clients because I tend to work mainly for accountants, but one of my main private clients is a gentleman who owns a landed estate in quite a big chunk of land, big house, lots of acreage, typical kind of business whereby we've got furnished holiday let, we've got long-term rental, we've got agricultural value rented out to farms. He does a little bit of farming himself, but not very much. And we are undergoing a succession planning exercise with this guy at the moment. His son is in his late 20s, and he is now starting to sort of get involved in the family business. Lots and lots of really, really wacky ideas of his own. And it's a bit of a nightmare because, definite conflict of interest in terms of this business. Anyway, now there was a derelict barn on this estate, which the son wanted to effectively renovate into a property in which he could live, because he was tired of living in the main house with his dad, even though they could effectively have a wing each. So he wanted to develop that property. Now, even though it was not worth a great deal, it did have planning on it. So there was intrinsic value in that. And the other thing is that my client has inherited this whole estate from his dad in the 1960s, which means that we have an incredibly low base cost for any property within the estate. Now, next to this barn, there is a big area of agricultural land which is rented to a local farmer. Now, if we had gifted that barn directly to the son, there would have been a capital gain and it wouldn't have qualified for holdover relief. But because there's no apportionment between qualifying and non-qualifying assets for property covered by APR, what we did was we transferred in a single transaction the property, the barn, and some agricultural land, quite a big chunk of agricultural land, and then we claimed holdover relief. So actually we got the property into the hands of the son. Now, if he'd been going to develop that property and sell it, then he would have had a very low base cost, and that would have increased the amount of tax he would have paid for development. But because he's building it to live in it, and if he sells it subsequently, we'll get private residence relief, that low base cost is not an issue, and so that works very well. So that's something that you can look at. Let's have a look at one or two other points. I'm already behind in terms of the information I'm giving out, so I'm going to have to speed up a bit. But please do continue to ask questions, because I do like questions coming in. Any consideration that's paid, there may be stamp taxes if there's consideration paid for shares. Then it may well be that there's stamp duty to pay. If it's property, then there could be stamp duty, land tax. If you are gifting to a connected company, so if you were doing succession planning and the first thing that you did was transferred an unincorporated business into a company, don't forget the stamp duty, land tax on the market value of the land. That might be quite unusual if we're talking about succession planning. And unless we're, as I say, we're talking about pre-incorporation. Obviously, we need to consider the IHT in all of this. If you are gifting assets which qualify for holdover relief, then typically they should also qualify for business property relief. Need to be a little bit careful in the situation that I was talking about before, where you perhaps gift shares, but you don't gift the associated property, because you could lose BPR on the property. And the gift will typically be a pet. If the transferor then dies within 7 years, you should retain the BPR, but you just need to be quite careful, because the person that you have transferred the property to has still got to own it at the date of death, and they've also got to still qualify for BPR if they still own it. So if you transfer shares in your trading company to your kids and they get tired of it within a couple of years and sell it, and you then die, then there is going to be that pet becomes chargeable. You wouldn't get BPR on it. So you do need to be a little bit careful in those kind of situations. So transfers into trust. One of the issues that we do sometimes have is that people want to start doing a bit of succession planning, but they are concerned about the trust. Sorry, they are concerned about transferring directly to their children. Now, using a trust isn't necessarily terribly helpful from a tax planning perspective, but there may well be non-tax reasons why you want to do it. So, for example, you may well have concerns about the capacity of the transferee, or you might want to protect assets. I mean, the one that we hear quite often is that, you know, that one of the kids has married somebody that the parents don't like, and they're concerned about what happens with their family business if there is a divorce, if they've transferred the assets across. Or it may well be that they want to transfer the assets to a pool of beneficiaries. The other thing about using a trust is that it does actually allow the parents to be able to remain in control, because they can be a trustee of the trust, so that they can effectively continue to be involved in the business as well. I have a little bit of a love-hate relationship with trusts, really. And I think that is probably because I have dealt with 1 or 2 cases where people have used trusts and it's all gone a bit pear-shaped, and then we've had a huge problem trying to unravel the trust scenario simply because of the fact that we haven't it hasn't done what we've wanted it to do. I also think that if you're using a trust, you've got to have a bit of an end game. You could transfer your assets into a trust, but then if your kids don't actually want to get involved in the business, for example, you are then left with a trust with shares in it perhaps, or a business in it. And so you've got to have a little bit more, I think, of a cohesive plan as to what is going to happen kind of going forward, if you have got a trust being used. So it is something that we can think about, but I do think it's quite a high-end bit of planning, really. The one thing that's quite important is this, that the only kind of transfer into trust that is a potentially exempt transfer now is where you're using a disabled person's trust. Otherwise, it is going to be a chargeable lifetime transfer. So unless you want to pay some IHT, then obviously the value needs to be below the nil rate band, unless you have availability of CGT, obviously, as a BPR, business property relief, or something similar. But obviously, one of the things that is quite good with trusts is that there is no restriction in the type of asset that you can use. So actually, you've also got the ability to use trusts for planning with non-business assets. So, for example, if you wanted to pass on shares in an investment company, and, when we're talking about succession planning, we are sometimes also talking about non-business assets. So, you do have the possibility of doing that. Holdover relief is due if it is a chargeable lifetime transfer, and that would be the case even if there is no actual IHT to pay, because either there's BPR or it's below the nil rate band, for example. If IHT is paid, it is an allowable cost when calculating CGT in the future. So, again, that is something that you can look at. So the other option that you have is to hang on to your assets and transfer them to your kids on death. Now, one of the obvious reasons for doing this is particularly if you can mitigate the inheritance tax liability. We have a tax-free uplift for capital gains tax purposes, which means that your beneficiaries acquire the assets at market value, and therefore if they then sell them, they don't pay capital gains tax. The slide deliberately says that there is a tax-free uplift currently, because over the last 18 months, we have had 3 reports from the Office for Tax Simplification, who are the people who deal with policy issues for the government, and they believe that the tax-free uplift where there is no IHT to pay is distorting the market or distorting planning. So we have a budget in a couple of weeks' time. I would not be at all surprised, though I would have to caveat that by saying I'm always hopeless at making predictions to do with the budget. But I wouldn't be surprised if there isn't some alteration to this. But we are talking about the position as it is today. And therefore, if we're talking about transfers of assets, then clearly mitigation of IHT is going to be our primary issue. And so we are looking at BPR and APR, business property relief, and agricultural property relief. And clearly, if you are planning on the basis that you are waiting to transfer assets on death, you need to be certain that you are going to get those reliefs. Now, One of the things that we do quite often see is inter-spouse transfers on the first death, where you've got a married couple. As I say, you get the tax-free uplift at that point. And then you have the the surviving spouse gifts assets to the next generation. No capital gains tax, but also no inheritance tax. And that is something, if you are looking at IHT planning, which is worth considering. But let's just think about BPR. You get 100% BPR if you are giving away an interest in an unincorporated business, or if you have a holding in an unquoted or AIM listed company. There is a 50% BPR available for controlling holdings in quoted companies, or buildings or other assets used for partnerships or companies. With a company, you've got to have control of that company, and that's the point that I was making earlier on about if you're giving away the shares, be careful if you hang on to the property, because you might lose your BPR. It must be relevant business property, and you must have owned it for 2 years prior to the date of transfer. In this situation, we would be talking about death being the date of transfer, though, as I said, this is also relevant when you are transferring assets in lifetime. So it's got to be a qualifying business, which broadly means that it's not a business which is wholly or mainly one of managing or holding investments. And people, of course, will be familiar with the cases that we've had recently on furnished holiday lets and serviced accommodation. So there are certain types of businesses where the question of whether or not it is a qualifying business becomes very, very relevant. We had a spate of cases about 15 years ago involving caravan parks, where HMRC were looking at sort of that business and whether it qualified. Any type of composite business where you've got different income streams, you've got things that potentially could be treated as investments, are obviously going to be vulnerable. You might be able to argue that you've got separate businesses in unincorporated situations, some of which qualify and some don't, but that is very, very difficult to achieve in reality. So I think that trading businesses are, again, normally going to be fairly obvious. Going back to the point that we were making earlier on about the trading company definition for BADR and holdover relief purposes, the BPR rules are currently wholly or mainly, so they're not 80-20 like BADR is. So you could have a situation where you've got a transfer which wouldn't qualify for holdover relief because the non-trading assets are too great, but it is still wholly or mainly trading, which would mean that you would get BADR. And so sometimes we do have situations where people can't actually pass on assets in lifetime, but they would still get BADR. Now, again, I say that currently that is the definition, because again, within the OTS report, they did suggest that they ought to alter the definition so that there was alignment between BADR and BPR. And when they talk about alignment, I'm almost certain that they're not going to relax the definition for BADR purposes. They're going to stiffen the definition for BPR purposes. If you are talking about shares, we also need to consider accepted assets, because that can restrict the BPR available. And again, as we have already alluded to, the biggest issue that we have is to do with cash. Now, there is a bigger problem with cash when we're looking at BPR and accepted assets, because an asset is an accepted asset if it is not being used for the purposes of the trade and there is no anticipated use for the purposes of the trade. in the future. Now, I know in the example that I was talking about, the gentleman concerned was stashing cash because the company had almost gone under a few years ago, but a certain amount of cash may well be prudent, but large amounts are not. You're not going to be able to sustain that argument with HMRC. So again, you could have an argument that shares qualify for BADR, but actually then there are accepted assets from a BPR perspective. So again, there can be a slight mismatch between those two scenarios. So again, that is something that you need to think about. I'm not going to talk about APR to any extent, because it is not something, I think it's a slightly more specialist area, but obviously we've talked about APR being available for agricultural land and buildings as well. And so that's something that we can look at. Now, one of the so we've covered transfers in lifetime, we've covered transfers in death. What about middle ground? It may well be that the current business owners actually don't want to give away control at the moment. Perhaps they're a little bit concerned that their kids are a bit flaky. They're not sure that they're really going to get involved, but actually what they want to do is give them a little bit of value in the company so that they've got an incentive to get involved. If you own a stake in the company, then possibly you will want to work harder to establish that company a little bit more. So something that we can use is growth shares, which is basically where you give shares which have no current value. So there's no disposal for CGT purposes because the assets have no value. And they would typically be non-voting shares with capital rights. And then effectively, as the company grows in value, then they start to get value and there is no point of disposal in the future. I mean, in some ways, this is, again, quite complex planning. It very much depends on the client and what it is that's driving the planning. And the other thing that's quite interesting, though, is that growth shares is a way of getting succession planning for investment businesses where you're not going to get BPR, where you're not going to get holdover relief. So you could issue growth shares. The key issue with growth shares is that you get the existing valuation of the company spot on, because you are only going to want to get future growth into the hands of the successors. So if you if you value a company at £1 million and you give your kids 10% of the shares in that company, then there is a disposal at £100,000. I appreciate that you can discount, so it would be less than that, but this is just an example. If you value it at £1 million and you give them growth shares such that they can only benefit from the growth over £1 million, there is zero consideration needs to be imputed there because there's no value. But there's no point valuing it at £1 million, giving them growth shares for growth over £1 million, if the revenue come along and say, well, actually, it's our view that the shares are worth 2 million. So that is a situation where I would say that effectively you need to be looking at getting a formal valuation, because that's the point at which HMRC actually do challenge these kind of transactions. Okay, so that's something that can be thought about. I've mentioned already that the OTS has sort of talked about the interaction with IHT and CGT possibly distorting decision making, and that might change. And there are one or two examples in your notes. And again, somebody else has asked where the notes are. I must confess, I don't know I don't know how you access the notes. So hopefully somebody from the organisers will just put that that information into the chat box for you. So here we have an example of different contrasts in terms of tax. This isn't a business, but this is sort of just a general example. So here's someone who's got cash resources of 200,000, subject to IHT on her death. But what she does is she invests in an AIM-listed share portfolio, which will qualify for BPR once she's held them for 2 years. They're then worth £450,000 at her death. She leaves them to her daughter, who sells them for £460,000 shortly after her mother's death. So those shares qualify for BPR at 100%. So there's no IHT to pay on that element of the legacy. Effectively, the tax-free uplift means that the gain of £250,000 is eradicated, and her gain would be covered by her annual exemption, which would be £12,300. That would be contrasted with a situation where shares are given to a child in lifetime, and then the donor parent dies within 7 years of the gift. There's no holdover relief, so there would have been CGT on the gain, and then you get a failed pet attracting IHT at 40% with no relief for the CGT previously paid. So you've got one situation where you get no capital gains tax, no IHT. You've got the other end of the scale where you have CGT on transferring assets, and then you get IHT on a failed pet as well. Now, obviously, the kind of situation that we're talking about is where you have holdover relief, so there's no capital gains tax in life, but effectively you've then got an issue because you don't get the tax-free uplift. So if we go back to this scenario, let's just say that this was shares worth £200,000 in a company of which Susan was the main shareholder. And actually what she does is she gifts them during her lifetime so that her daughter acquires them at £200,000. And then after her mother's death, she sells them. Then you're going to have the CGT liability crystallising. So you go from a situation whereby there's no CGT, there's no IHT, to one where you've got the CGT. And that's why gifting in lifetime can often be controversial. And therefore, that is one of the things that you've got to contend with. Now, obviously, the younger you do this, the more likely you are to survive the 7 years, but also the less likely it is that you're going to want to transfer your assets early. And so these are the kind of issues that you will be tussling with when you start to look at succession planning. I'm not going to go through this example, actually. It is in your notes. Because, as I've said, I'm already slightly behind in terms of where I wanted to be. So there we go. Now, reorganisations may seem like a slightly strange thing to think about when we're talking about succession planning, but actually, sometimes we need to think about whether or not we need to change a business to enable a succession to take place in the first place. And that might be because you need to effectively split a business to be able to find people who want to take it on, or it might be that different businesses are not going to have the same fate. So the obvious example might be, and I have had these situations, is that you've got a business that has got two kind of component parts to it. And it might just be something as simple as you've got a business that's got a retail arm and a wholesale arm. And let's just say you've got two kids and one of them works in the retail business and one of them works in the wholesale business. And it might be that those two children get on incredibly well and they are quite happy to jointly succeed to the whole of the business. It might well be that they hate each other. or there is a degree of animosity, or there is a dispute about how the situation, how they're going to work together, and so on. And so to that extent, you've got to think about splitting the business before you can think about any succession. So again, this is quite quite complex, but again, it might be something that you'll be looking at. So if you've got a group, I mean, if you've got an unincorporated business, then it's fairly straightforward, because you just transfer one bit of it into one company, or you transfer one bit of it to one child and the other bit to the other child. It tends to be where you've got companies that this is going to be an issue. Normally, we would be looking at something like a demerger to break a group structure. And as I've said, the kind of typical scenario is where you want to split the business between two different individuals. Now, what we might be looking at here is a statutory demerger, where effectively you have assets or shares distributed in specie to the shareholders. So it is a distribution, which means that you do have to have sufficient profits in the company per the Companies Act. So you've got to comply with all of the Companies Act provisions. And then there are a series of conditions which the legislation starts at sections 1073 of CTA 2010, which gives all of those conditions. Now, we will have a look at the specific tax implications and the conditions in a moment. But effectively, if you meet the conditions, then there should be no tax to pay. So you can relatively easily split out the businesses. But because it is quite benign from a tax perspective, to the extent that you don't actually get any tax payable, there are very strict conditions to be met. So there are actually three types of demergers that we would be looking at. Two types of transactions. Distributing shares to shareholders. Either way, you distribute shares directly to your shareholders, or where you distribute shares in exchange for new shares being issued in another company, and then you can also distribute a trade in that way. So if you've got a holding company that's already got two subsidiaries, so let's just say you have got your wholesale business in one and your retail business in the other, you could just distribute one of those subsidiaries direct to the existing shareholders, and that leaves the original holding company just holding the shares in the second subsidiary. And then you have two companies, and then you can gift the shares in those companies, assuming again that they are trading companies. You would then just gift them to whichever one of your offspring wanted to succeed to the business. Alternatively, you could transfer the shares in that subsidiary to a new a new holding company, in exchange for shares being issued to the existing shareholders. With a subsidiary company, it's probably unclear why you would want to have a new holding company, but as we all know, clients have very strange ideas about the way that they want to proceed, and so it could well be that that's what you end up doing. Or you have a trade where you transfer the trade into a new in exchange for shares being issued in that company. So relatively straightforward. Obviously, you would need to get a lawyer involved in order to make sure that you get all the paperwork right, because it is quite important that all of the chunks of the sort of process work properly in order to make sure that you get the reliefs. So the conditions. And as I've said, these are quite stringent. All of the companies concerned have got to be resident in an EU member state. Now, it used to be that they had to be UK companies. That was changed because it breached EU law. Now, that change was enacted, I think, in 2012. It would be open to HMRC to change the legislation. So once again, they have to be UK companies, and I suspect that they will do that at some point. There are lots of bits of legislation where, you know, there's just a reference to the EU, and I imagine somebody is currently going through and highlighting all of those bits of legislation with a marker pen, and the government will slowly go through and decide whether they want to change that back. They've got to all be trading companies or holding companies of trading groups. And that has got to be before or after. So you can't use this mechanism to separate out an investment and trading. So for example, if you had this kind of structure where subsidiary one held the property rather than each of those holding trades, where subsidiary one held the property from which subsidiary two traded, and then subsidiary two was the trading company, you couldn't use this kind of mechanism to separate out the trading company from the investment activity. So you need to be a little bit careful. Now, in that situation, you could actually transfer both of the subsidiaries out from underneath the holding company. And this mechanism is sometimes used in order to actually separate out, so to get rid of holding companies. So effectively, you could do that. Now, you would then say, well, the holding company is not going to be either a trading company or the holding company of a trading group. But if you liquidated that holding company, then that would work. Only non-redeemable shares. So this does not work if any of the shares, either the shares being transferred or indeed the shares being issued in the new codes are redeemable. And if you are transferring a company, it must be effectively the only thing it does must be the carrying on of the trades that are transferred. So again, you have to be slightly careful if there are any non-trading activities. Continuing for the conditions, the distribution must be for the benefit of some or all of the trading activities. And it can't be part of a scheme or arrangement either for the avoidance of tax, the making of chargeable payments, and those are specifically defined, somebody getting control of a new company, or cessation of a trade or its sale. And there is a clearance process to get confirmation of that. So again, going back to our little diagram, let's just say you had this set up, subsidiary one was a trade, subsidiary two was a trade. Actually, what you want is your children want to succeed to the trade which is in subsidiary one, but not this trade that is in subsidiary two. You don't want the holding company to sell subsidiary two because then you can't get the cash out. And so what you'd quite like to do is demerge them and then sell subsidiary two. Hopefully you get BADR on that, you get the money in your pocket, and then you could transfer the business to your kids. Doesn't work because you would not get clearance for that to be a statutory demerger. So again, there are limits on this. Now, the clearance process in this situation is to get confirmation that the distribution is going to be for the benefit of the trade. Now, historically, HMRC have been fairly chilled about clearances for demergers, for separation, for things like succession planning, it's not particularly been something that they've been too bothered about. But we are seeing a real ramping up of the compliance work that is being done in relation to clearance applications, and we are getting pushed back on quite a few clearances. So I think separating out two activities where there is demonstrably individual succession, you should be okay, but you do need to, have a good, you have a clear idea in your own mind of what it is that you're trying to achieve. I've just got hiccups. So the distribution is exempt. So there's no income tax charge on the shareholders. There is theoretically a capital gain in the company on the disposal of the assets, but if you're transferring shares, it should be covered by a substantial shareholdings exemption, or it may be exempt as a business reorganisation under legislation which is at section 139 of TCJA 1992. There is a part disposal of the shares, but it should be a reorganisation falling under section 136 of TCJA 1992, and there should be no stamp duty or SDRT. So it should be possible to do that, with the only thing that you have to pay being the professional fees. So yeah. Now the next slide just says basically, if you're separating it out so one can be sold, then you're not going to get clearance. And actually, if you did sell it within 3 years anyway, the sale would be a chargeable payment. And as I've already said, that would be something that you might look at as part of succession. If you've got a subsidiary company, you'd be much better off selling that and getting substantial shareholdings exemption, so you don't pay tax in the parent company, but of course you then don't get the money directly, which might mean that it is less benevolent, really. Now, obviously, you could say, well, we just won't tell the revenue, we're going to sell it. Now, as I've said, a sale within 3 years would be a chargeable payment, and you would get reversal of the clearance anyway. But HMRC aren't stupid. If you do this and you do sell it, within probably a 5 or 6 year period, they might go back and say, well, what's changed? It's not inevitable that they're going to pick it up, and it's not inevitable that they're going to challenge it. But particularly when we're talking about, large sums of money, I think you would want to be very careful in terms of, making sure that, that is something that that you're not going to fall foul of. So, I would suggest that you need to be questioning your clients at some length as to, what it is that they want to do. So sometimes it is not quite as straightforward in terms of what you are trying to achieve. Now, this was a client of mine where we did a reconstruction where the interaction between holdover relief and reorganisation provisions ended up giving us an outcome which was quite useful. So this was a client who was the sole owner of a company which had 2 subsidiaries. Those 2 subsidiaries were in the same industry, but to be perfectly honest with you, they were in an industry where, for reasons broadly associated with climate change, it is likely that those trades are going to diminish. Probably not in the immediate short term, but certainly over the next couple of decades, and could well, if there was any acceleration of punitive legislation in certain areas, could well accelerate reduce much more quickly than that. So we have a business which is possibly not really worth transferring onto the kids. They could have a short-term business, but they're not going to have a long-term business proposition. Now, the parent company owns the properties from which the subsidiary companies trade. Now, this chap, George, has 3 sons. In reality, the sons don't want to have any involvement at all in the 2 trading companies. They're not very attractive businesses. This client has nothing good to say about his sons, to be perfectly honest with you. And part of it is that he's pretty disgusted that they're not really willing to get their hands dirty. But, that's the situation. He loves his children and so on. Now, they would quite like the boys to get involved in a kind of a property investment type business. So they would like to buy and sell property, or they'd like to buy it, do it up and rent it out to get an income stream. Obviously attracted by all of the narrative that is online, if you look far enough, for people who, in their 20s and 30s establish a huge property portfolio and then live off the proceeds for the rest of their life, so that they don't really ever have to work. And I have to say that I wish I'd done that when I was in my 20s or 30s. So what they thought was, because the properties from which the subsidiary companies trade are ripe for development, I think it's probably the phrase that you would use. So they are certainly going to have value. They could certainly be developed in the future. And as the trading businesses contract, there is going to be spare capacity anyway. And so what we wanted to do was we wanted to effectively separate out the properties into a new co to be owned by the sons, though, as you'll see, we actually did this so that the client also had a stake in the company. So the idea is effectively to have 2 businesses where where George retained the trading businesses, but we've separated out the properties. Now, obviously, couldn't do this by doing the statutory demerger, because we are effectively separating out an investment activity, albeit an investment activity which is currently associated with the trade. But the question that we looked at was whether we could do some kind of reconstruction which would enable us to actually achieve this. Now, we can do what is called a liquidation demerger, which is where, as the name suggests, one of the companies within the group is liquidated. It's a solvent liquidation under section 110 of the Insolvency Act. And as part of the liquidation, the liquidator will transfer assets to the new co, in exchange for shares in the new co being issued to the old co shareholders. And that's not an income distribution for their scenario, in this scenario, because it's part of a winding up. So the tax consequences of a liquidation demerger would be that it is a capital distribution, but it is exempt under section 136 as a reorganisation. Again, we've got a gain in the company, but it's covered by section 139. Now, both of those bits of legislation rely on this being a scheme of reconstruction, and it must be done for bona fide commercial reasons. And once again, as with the other one, we have prior clearance. And the clearance and the ease of getting clearance, I would refer you back to my previous comments. in that this has become a much more difficult process in recent years, though it is not impossible to achieve, as we will see in a moment. The scheme of reconstruction is defined in TCGA 1992. You've got to meet first two conditions and then one or the others. And in something like the scenario that we are going to look at in a moment, whether or not something is a scheme of reconstruction is quite a technical area. It's not even really something that I tend to advise on. And then that is because most of the transactions that I get involved in are relatively straightforward. So the proposal, let's just go back to the scenario so that we remember where we were. So we have parent company GHL, which owns the property. We've got two subsidiary companies which are trading. Because GHL owns the properties from which the subsidiary company trades, and there's no other investment assets, the shares in GHL are eligible for holdover relief. So the first thing we do is we transfer some shares in GHL to each of the boys. So they become a shareholder in GHL. Now, we can claim holdover relief on that because it is a trading company or the holding company of a trading group. Now, if you remember when we were talking about holdover relief earlier on, we started off there. Yes, there can be a clawback of a relief if the recipient becomes non-resident. But there's no clawback if there is a change in the status of the shares subsequently. So at the time it is a trading company, we transfer the shares to the boys. We then do a share for share exchange and put a holding company above GHL. Now, and then what we do is we effectively transfer the shares in GOL, COL, so that we've then got a linear structure. We've got the new holding company, and then we've got three subsidiaries, the company that holds the property and the two trading companies. Now, the reason that we do that is because we need to liquidate a company. And the property that is in the existing holding company would need to be transferred out. And the mitigation of the capital gain on a liquidation demerger only operates easily with shares. Now, we can't transfer that property into a new company because then we would get a degrouping charge from SDLT purposes. So the property needs to remain in the company. So we do a share for share exchange. We then partition the shares in the new co into A and B shares. The boys will hold B shares, and then George owns both B and A shares, and then the rights associated with the shares are amended so that the A shares have entitlement to the trading businesses and the B shares have entitlement to the property holding company. We then liquidate the new holding company. The shares in the trading companies are distributed to a new co, with shares being issued to George, and the shares in the property company GHL are transferred to another new co, which is held 25% by George and 25% each with by the three boys. So we end up with a situation where we have split out the property into a new co, but we've also taken advantage of the fact that the company is initially a trading company. So we've claimed holdover relief to get the shares equal to be able to do this. So the $64 million question here is, of course, are we going to get clearance for this? Well, we did get clearance for this. Clearance was not straightforward. We did get asked a lot of questions. So the revenue did really drill down into what the plans were, why the boys didn't want to get involved in the trading businesses, why the structure, what they were going to be doing going forward exactly. So, and to a certain extent, it was quite difficult because this was a fairly sort of woolly plan. In reality, all the boys knew was that they didn't want to get involved in their dad's businesses, but they quite fancied the idea of being property magnates. They were still relatively young as well. One of them was still at university. So actually, excuse me, we had to answer the questions as honestly as we could, without being incorrect. And so it is quite difficult, but we did ultimately get clearance. Now, I think this also raises quite an interesting point. George wasn't particularly bothered about being a shareholder in the property investment business. He would have been quite happy for the boys to actually get all of the shares. But my feeling was, and I think that this was probably subsequently borne out by the questioning that the revenue did, was that I didn't think it would be as easy to get clearance if we were actually just separating the two things out completely. It just felt like a much more cohesive story. Now, the use of the word story suggests that we were lying, but we weren't. We were telling the truth. You know, effectively, it is still something that was achievable. It just felt like it was much easier to kind of argue that, well, you know, we are giving some of this value. Now, one of the reasons why George actually wanted to get rid of the property altogether, and why with him ending up as a 25% shareholder was not particularly helpful, was of course because that 25% of value in the property investment company would not qualify for BPR. So he went from a situation where 100% of the value was covered by BPR to a situation where he was going to have some value that was within his estate. But I think it would have been incredibly difficult in reality to actually have justified it in any other way. Now, I suspect that the direction of travel with this company is going to be that, I don't know why I think this, I don't think that the boys are going to knuckle down, and I suspect that what is going to happen is that they will just carry on with this being a property investment company, and at some point George will wind down the trades and the property will be sold. Now, it might well be that I'm very wrong, but obviously there will need to be some IH2 planning done at that stage. So it wasn't a perfect situation, but it got us partway down the road. And I think sometimes with, succession planning, you have got to say to the clients, well, we can't achieve what you want us to achieve in its entirety, but actually we can get partway there. You have to make a return to the revenue if you do this kind of demerger as well. There are alternatives to doing the liquidation demerger, which is called a capital reduction demerger, which is pretty much the same thing as a liquidation demerger, but you don't do a liquidation. Now, these are really, really complicated, and I would suspect that if you're going to undertake something like this, you would probably need to take detailed advice. Apologies if there is anybody on this session who would be confident in doing this. But again, typically why you're doing a capital reduction demerger is to mean that you don't have to move assets around so that you don't get the SDLT issues. And basically what you do is pretty much what we did with the liquidation demerger, but you partition the shares and you put a new holding company above and so on. But then what you do is rather than liquidating the top companies, is you do a capital reduction where you issue a solvency statement, and effectively the A shares in the company are cancelled, with the trade that is linked to the A shares then being transferred out to a new co, and the previous business remaining intact. And as I say, we typically do this to avoid the SDLT degrouping charge. Oh dear, I have got a bit of a cold, so I do apologise that I'm coughing and spluttering a little bit. So basically, a capital reduction is a little bit more complicated, and you still need all of the same clearances from HMRC as you do if you are doing a liquidation type demerger. And so, it is not always going to be straightforward. Now, it's 28 minutes past 10. We have been going for nearly an hour and a half. I think that we will have a break now. I will come back online at about 20 to 11. So hopefully that will give you just over 10 minutes to go and make yourself a cup of tea, have a comfort break, whatever, take the dog out in the back garden, whatever. So I will switch off my screen and my microphone. But if you do have any questions which occur to you while you're standing by the kettle, please do feel free to pop them in the chat box, and I will answer them when we come back. But I'll be back around 20 to 11. Okay, I make it 20 to 11, so we will start again. So with regard, so I've had a question come in, with regard to the splitting of two distinct trades within a company, we are currently experiencing HMRC pushback in that within one of the split companies, the director shareholder, who is 70, is then looking at gifting his shares to his daughter and son-in-law who work within the business. Yes, I mean, I think that is a very good example of the fact that HMRC are now being very, very precise in terms of the questions that they're asking, looking at exactly why it benefits from the trade. For the trade, I mean, it depends what test you're looking at, because the statutory demerger test is looking at whether or not it benefits the trade. The section 136, section 139 and so on that you're doing with, say, something like a liquidation demerger is relying on whether or not something is being done for bona fide commercial reasons, and not for the avoidance of tax. So there is a subtle difference, I think, in the way that that you approach this in some scenarios. So yes, I mean, it is difficult, and obviously depending on the individual circumstances will depend on the extent to which you can go back. I mean, in the case that we had with our liquidation demerger with George, we just kept going back and being consistent and reiterating what we were saying, about the fact that this was really the only way that the business could proceed in the future. So, but as I say, that was bona fide commercial reasons, and so it was a slightly different approach. So I would agree that any advice that you're giving to clients has got to be very much caveated by the fact that it is not straightforward. But thank you for that. That's a great. It's always good to have these examples. So, looking at succession planning. One of the things that became quite a sort of, I hesitate to use the word trendy, because my daughter always laughs at me when I say that. But an idea that became quite popular was the use of family investment companies, and really the idea of a family investment company is that you set up a company which is not just held by the parents, it's perhaps held by the children. You bring your business interests under the umbrella of that family investment company, and you can, particularly if you've got trading businesses where you don't need to take all of the cash out of those businesses, you then dividend up the profits into your FIC, which can then invest it, and you get growth of investment value outside of your estate, because your kids effectively own shares. So the starting point is often to bring that trading company in under the umbrella of another company. And as I said, normally that other company will be held by other family members. Moves value out of the estate. You do have some downside, a bit like with George, in that BPR is lost on the trading company, but that is compensated very much by the shift in value. Now, this relies on us being able to create a group. So this is, another step in the sort of reorganisations. And effectively what happens when you have a share for share exchange, and again, I'm sure that many people on this call will be familiar with that, is that you effectively sell the shares in one company to another, but the consideration is shares in the new co, and that is treated as the share reorganisation under section 135 of TCJA 1992, and there's no crystallisation of the CGT liability. And there are various technical conditions which are typically always met. But again, we have this idea of this being done for bona fide commercial reasons, and not for the avoidance of tax. And there is a clearance procedure which exists. And actually in this scenario, we would also normally apply for clearance that HMRC do not consider that the transactions and securities provisions apply. But we are having real problems with the creation of these at the moment. This is the area where we are seeing most pushback from the revenue in terms of clearance, because they're basically saying, well, why can't you just extract the dividends from your trading company and pay tax on them and then just put that into an investment company? Why is it for bona fide commercial reasons that you create the possibility that you can avoid tax on your dividend income and then use it for investment purposes? Now, the typical problem that we are getting is in situations where the family are just thinking, well, yes, this will be a good idea, but they haven't really got any idea what they will do with the money, what they will do, and what kind of investments they might be looking at. They don't really have any idea. They just think that it would be a good idea to start this process. So again, the message that really comes out, I think, from any kind of these transactions, and in particular when you are applying for clearance, exactly why, what the commercial rationale is, and have a much more robust long-term plan. So I've had two recently where clearances that I've seen where clearance has been turned down. The first is where the person effectively wants to create a group structure, and wants to invest in other businesses. And as soon as the revenue said, well, what other businesses do you think you might invest in? He rather inadvisedly sort of said, well, I don't know yet. I haven't really thought that far. Unfortunately, the client was dealing with the responses to the revenue themselves, which is obviously something that we would never suggest is a good idea. And then the other one was where they wanted to create a family investment company, where they would sell the shares and then invest probably in property, but again hadn't really got a very resolute idea of what they might do, and the revenue just said, well, we don't think that it applies. So yeah, we are having real problems at the moment. The other problem that we have in these situations, particularly where you have got, you're trying to establish a family investment company with other family members involved, is that you won't have a mirror image of the shareholdings before and after, which means that you're going to pay stamp duty on the value of the company that's being acquired. And obviously, if you're trying to get a trading company into that kind of group and it's worth, you know, £3 or £4 million, even though it's only 0.5%, it's still quite a big amount. Actually, just before I, I move on, one of the questions that I do get asked quite a lot is, well, why can't we just do this without clearance? Why do we have to tell the revenue what we're planning on doing? The problem with not going for clearance, particularly in a situation where you might think clearance won't be given, is that it's very, very difficult to stay under the radar. Now, I used to work for the revenue. It's a very, very long time ago since I left. I can't tell you how long it is because you'll know how old I am. But you can probably guess that as well. But when I worked in the revenue, as I say, which was a very long time ago, if we came across a transaction where somebody had done something like this and they hadn't applied for clearance, it was a mandatory inquiry case. So you had to take it up for an inquiry. Now, I don't think that is the case anymore, because I have seen situations where clearance hasn't been applied for and the revenue have just let it pass by. But given the way that clearance section is at the moment, I don't feel comfortable at all allowing clients really to go ahead and not apply for clearance in situations where actually it is available. So I don't think that is a realistic possibility. Now, what if the departing shareholder actually needs to get some money out of this business? So if they effectively don't have the luxury of being able to just give away the assets. Now, it might be that they need funds to fund their retirement. There are an awful lot of people in this country who are effectively see their business as their pension pot. So they haven't really taken any opportunity to generate any other pension savings, which is why often the idea of holding on to the trading premises is quite a good one. But let's just say that you are in a situation where you need some money from your business. Now, as I said, some people just decide that they're going to do that anyway. That they're not going to just allow their kids to have the money without any kind of question. But what about different options? Of course, you could just give away some of the shares and then get an income stream from the remainder of the shares. But obviously, particularly if you're passing control on to the next generation, you are vulnerable, because if the next generation actually make a bit of a Horlicks of it all, I was trying to think of a polite word there, then you might lose that income stream, and you also then are not cashing in on any current value of the business. So one thing that we often see people looking at is purchase of own shares. So this is where the company repurchases shares from an existing shareholder, from an exiting shareholder, sorry, which allows them to get some value. Now, the default with purchase of own shares is that it will be an income distribution and it would be subject to tax as a dividend. But most people, I think, will be aware of the fact that it can be treated as a capital distribution. But you do have to meet certain conditions. it is very important to acknowledge those. We'll look at the conditions in a minute. If you meet the conditions, then it will be subject to capital gains tax, which then also gives the possibility that you can ask for BADR, business asset disposal relief. Now, it is quite important to remember that you have to also comply with the Companies Act. So, for example, the company has to have sufficient distributable reserves to be able to pay for the shares, and it also needs to be able to pay for them in cash. That is a Companies Act requirement. You cannot do a purchase of own shares in any deferred manner, although it is possible to do it from a tax perspective by using deferred completion type scenarios. So what are the conditions? The shareholder must be resident in the UK, though I would say is that if the shareholder is not resident in the UK, you won't get capital treatment in the UK itself, but of course you would just need to consider what the tax treatment is going to be in the jurisdiction where the person is resident. So it's not inevitably a disaster if someone is not resident in the UK, but you would obviously just need to look at their local legislation. They need to have owned the shares for more than 5 years. And actually that is something that people do sometimes overlook. Now, in a succession planning exercise where someone's held the shares since the ARC sale, then that's not going to be an issue. But just in general terms, purchase of own shares, you have to have 5 years. I had somebody who submitted a clearance application recently for a purchase of own shares, and the revenue turned it down because the chap hadn't owned the shares for more than 5 years. And the accountant phoned me up and he said, "Oh, see, I feel so stupid that I didn't spot that." And he said, "And I feel really quite embarrassed to go back to the revenue." And I said, "Well, when's the 5 years up?" And he said, "Oh, the 5 years is up in next January or something." And I said, "Well, just write back to the revenue and say, really sorry, in the original clearance letter, I should have mentioned that we're going to do this once the 5 years is up." So I said, just pretend that you made a mistake in the clearance letter rather than making a mistake in the actual technical guidance. But that was quite lucky that you could get out of that one. And I should point out that 5 years is absolute. There are no circumstances in which that 5 year holding period is relaxed. So, that is quite important. It's got to be an unquoted trading company. Again, it's wholly or mainly trading. So it is not the BADR definition, it is the BPR definition, which means that you could have a situation where somebody is eligible for capital treatment for purchase of own shares purposes, but would pay 20% rather than 10% because they don't qualify for BADR. Often people want income capital treatment so they can get BADR, but there is that point to remember. There's two then connected bits of legislation. In absolute terms, the shareholder can't be connected with the company after the purchase of own shares. Connection is more than 30% of the shares, but their shareholding also has to be substantially reduced, which effectively means it's got to drop down to less than 75%. And it's got to reduce by 75% of what was there before. Don't forget, when you're looking at substantial reduction, that the number of shares in issue is going to reduce as well. So it's not necessarily a straightforward calculation, but that has to be done. There is a caveat to that, though, and that is that in reality, HMRC are very unlikely to give clearance to somebody who ends up with, say, 29% of the shares. So even though theoretically that you can have up to 30% of the shares in a company after a purchase of own shares, it is very unlikely that the revenue would give clearance. You have to be able to argue that this is for the benefit of the trade. And again, there is an advanced clearance, and again, it is different from the bona fide commercial reasons test that we've discussed already. Are there any particular issues when we have got succession planning? Well, in reality, I think probably the biggest one is structuring it as, is really what reduction in shareholding you can get away with. Because I think this goes back to the kind of theme which I hope has sort of driven this morning's presentation. And that is that often the big problem with succession planning when you're talking about family is that the current owner doesn't want to give the whole thing away at once. They are probably thinking more about some kind of phased process whereby they end up just, giving part of it away, see how it goes. And so saying to somebody, well, you probably can't have more than maybe 10 or 15% of the shares after this transaction may not be something that they're really very open to thinking about, which is why sometimes we kind of do buyouts or purchase of own shares by way of a buyout. So where, the successors set up a new company and then they effectively buy the old company, potentially even using something like loan notes to pay for it, which means that they can then effectively fund the purchase out of subsequent profits that they make. And again, the parents could end up having more shares. They could get a share for share exchange tax scenario. And again, then we're looking at bona fide commercial reasons rather than benefit for the trade, which can sometimes be a little bit easier. And again, I would have to be honest with you and say that we have still seen some pushback. What I would say is structuring it as a buyout does tend to mean that you can have a high level of shares remain with the parents. What I've really detected is that the revenue are reasonably happy as long as the existing shareholders, the current shareholders, don't have more than 25% of the shares. Because obviously once the other shareholders have got 75% of the shares, then they can, they can put in place special resolutions and so on. So I think that generally that is the sort of that's the sort of figures that we're looking at. But either of those things would allow you to get some value out of the company if you needed to do that. Okay, I think I've probably said all I need to say really about family succession. So the other sort of main type of planning that we look at is employee succession. And many of these kind of ideas are hugely problematic. The first problem that you come across is simply getting shares into the hands of your employees in the first place. But actually there is a much more practical problem from the perspective of the current business owners, because they may well have absolutely no idea whether or not there are any employees who are even vaguely capable of taking over the business. And if you have a business, which is something I see quite often, where the main shareholder is sort of in their 60s or maybe even their 70s, has always run the company with an absolute iron fist, has never delegated any responsibility, may well employ quite a lot of people, but actually none of those people do have any real managerial experience because they've never really been given that opportunity. Identifying who might take over can be an absolute nightmare. So if we were looking at offering shares to employees as part of succession planning, what we typically see is that we will have, a drip feed. So we have a sort of a process whereby you have shares being given to employees over a period of time. Management buyouts do happen where you have an arm's length sale to a group of employees, and we'll talk about those at the end. Basically, what we're looking at here is really a situation where you are drip feeding over a period of time. Now, you can obviously give shares to employees. There are share schemes where you can have options. The real problem is that all shares that are given to employees are employment-related securities. Actually, that statement is wrong. You can gift shares to members of your family who then avoid the employment-related securities provisions if they are family members. But that would only apply if you actually have a gift from an existing shareholder. It wouldn't apply to shares being issued directly from the company. So you do need to be careful. But if we just park to one side the possible exception for family members, all shares are employment-related securities. And in the early 90s, there was a lot of tax planning involving very creative schemes whereby shares were used and the tax position was mitigated. So we are now left with a huge amount of provisions that really largely fall within the anti-avoidance sort of idea. And it is very, very punitive legislation. So the legislation doesn't actually just apply to shares, it also applies to securities, but we'll talk about shares. It applies to shares acquired by reason of your employment, and that would include former or prospective employment. And as I said, there is an exclusion for family members. But basically, employment-related securities are taxed under Section 62 of IT 2003. They are an emolument. And this was confirmed in a case in the 1960s called Salmon v. Waite. Actually, might have been in the 1970s, but it was a long time ago. And basically, there is a tax charge on the difference between the price that the individual pays and the market value. Now, that's straightforward. But the problem is that where you tax something on the difference between the price paid and the market value, if you can manipulate the market value, then you can mitigate the tax charge. So if I can do something with the rights attached to those shares, then I can reduce the amount of money that that is payable in tax. And that's where all of the anti-avoidance provisions come from, because all of these ways were used to manipulate the value. So there are basically 7 main bits of anti-avoidance legislation. Restricted securities, convertible securities, shares that have got artificially suppressed value, shares that have got artificially enhanced value, shares disposed of for more than market value, and then something called post-acquisition benefits. Now, to be honest with you, the one that we see in practice is restricted securities, because this is one of the easiest ways to reduce the market value of shares, to restrict the rights or make them subject to forfeiture, or indeed have any situation where you're not going to get the market value back for them. Now, the real problem with the operation of the restricted securities provisions is that there is no motive test. So if you give shares to your employees and you decide that actually, if that person leaves within 3 years, you want those shares back, that's probably a legitimate commercial decision, because nobody wants someone who is no longer an employee being a shareholder in their company. But that would still make those shares restricted securities. So there could be a problem down the line in relation to those shares. Now, there are 3 types of restricted securities where there is transfer, reversion, or forfeiture of the employment-related securities on any specific event, restriction of your ability to dispose of the shares or retain the proceeds of sale, and then the any other business of the tax world, any other restriction which reduces the value. Now, many small companies have preemption rights in their shareholders agreement, which says that you have got to offer the shares to your fellow shareholders before you can offer them to someone else. Now, if those kind of restrictions apply to all of the shareholdings of the company, then that wouldn't make them restricted securities. But the one we see most often is the forfeiture, or where you've got to transfer the shares to someone else if you leave the company. There are exceptions, but again, most of those are not going to be something that we would see in a basic succession planning provision. So basically, the way that the legislation operates where we've got restricted securities is that you, I was just thinking, there's 2 bits of legislation we need to think about. If your restriction is under the first one, so transfer, reversion, or forfeiture of shares, and that is going to be lifted within 5 years, you have no tax charge when you originally acquire the shares. If that doesn't apply, and you can disapply that piece of legislation, and we'll look at that in a moment. If that doesn't apply, then you have a tax charge on the difference between the actual market value and the price that you pay. So if the market value is less, then you pay a lower amount of tax. But then what happens is that if there is a chargeable event, you have a subsequent income tax charge. And that income tax charge can arise where the shares cease to be restricted, or indeed they are sold while they're still restricted. Now, the tax charge is calculated according to this formula. But it's a bit, we've done a bit too much training already this morning to go through that in any detail. But effectively, what you are looking at is how much value is untaxed when you get the shares originally. And then you tax that each time there is a chargeable event, based on the market value at the time of the chargeable event. So the easiest way to look at this is to look at an example. So we pay £7 for shares, which is the market value at the time, but if they didn't have restrictions associated with them, the market value will be £10. We have a chargeable event happens when the actual market value is 12 and the unrestricted market value is 15, and then we have a final chargeable event, a second chargeable event. I've made this example very, very complicated. And then we have a third chargeable event when there's no restriction, so the actual market value and ultimate market value are the same. So basically, initially, 30% of the value of those shares is untaxed. When we have the lifting of the first restriction. The difference between the actual market value and the unrestricted market value is 20%. So we bring 10% of the value into charge. After the lifting of the second election, only 6.25% is untaxed. So we are going to tax 13.75%, and then we tax the remaining 6.25% when the third restriction is lifted. In reality, we normally only have one restriction. So you not only have compliance at the beginning, but you also then have to keep an eye on it. Now, you can make an election to treat the shares as if they're unrestricted, which effectively means that you potentially accelerate the tax charge, but then you won't have to pay anything further going forward. The disadvantage is that if the value of the shares goes down, you don't get the tax back. You have to make an election within 14 days, although it doesn't have to be submitted to HMRC. So it is a complicated area, and we do need to be very careful about this. Now, I've had a question or a comment. We have a client who is offering shares to his employees. When the employee quits, they buy back the share at a lower value. For example, shares offered at £1 per share and bought back at 80p. I was wondering how to book the difference of 20p and the tax treatment. That's a really interesting question. So I'm assuming from what you say that the employee buys the shares for £1 a share. But then that doesn't make any sense to me because they get less back than what they paid for them. So I'm slightly puzzled by that. But let's just say, for example's sake, that the employee doesn't pay for the shares at all. Sorry, I'm not sure that the next comment really clarifies it. Just whether they are buying them or whether they are getting them free. If they're getting them free, there would be a tax charge based on £1 per share when they acquire them. And then when they're bought back for 80p, there would be a capital loss. Well, actually, no, there could potentially be a capital gain because it's going to be a connected party transaction, which means that if the market value of those shares is more than 80p, then there would potentially be a capital gain on the difference between the market value and the pound. Because if you've paid income tax on the pound, then that is the base cost for CGT purposes, and it would only be the growth in value going forward. But there could still be a CGT. So if, for example, those shares are worth £1.50, even though they're already being bought back for 80p, then there would be a 50p capital gains charge on each share. So even though the question is to how to book the difference of 20p, I think that there is tax position beyond that, because I think there will be an upfront tax charge. As I say, I can't particularly see why it would be advantageous to the employee to buy shares for £1 and then only have them bought back for 80p. So I'm assuming that they are getting them free at that stage. But that's a very good example because it demonstrates that actually sometimes employers just do things without really thinking about whether or not it is a very good idea or not. So in broad terms, we have this idea of a tax charge up front, and I'll look in a minute at approved share option schemes where you can perhaps mitigate the tax. Now, at the beginning of this section, I said that sometimes you have a situation where you will have, say, an MBO, a management buyout, where you are selling to employees, but really you are selling to a group of people a third party that just happens to include employees. Now, often in that situation, the managers may well just be buying you out, but often those kind of purchases will be backed by external finance, sometimes by private equity, though it depends on how big the company is. Even though we typically think about private equity buying, businesses like Morrison's, that's just happened. Sometimes they will get involved in smaller businesses. But sometimes when we have MBOs, we have sort of very strange structures. And one of the things that we sometimes see is something called ratchets. They are sort of what might generically be described as performance-linked bumps in share ownership. So basically what happens is that your managers, say, start out with 10% of the shares and the investors have 90% of the shares. And then if they meet performance targets, then 10% of the investors' shares become deferred shares. And so the the managers have an increase in value of their share ownership. HMRC will expect that to be taken into account when calculating the tax charge on the initial upfront transaction. So you need to be very careful. If the employee exits, sorry, I had a question. If an employee exits a business and disposes of the shares, having set up a Section 431 election, I believe if the shares are purchased back by the company, they have to have been held for 5 years for CGT to apply. Otherwise, it is income tax. Is that the same for disposals to individuals, other shareholders, for example? Is there a 5-year limit in that instance? The answer to that question is no. So if you have acquired shares in your company and you sell them to another individual, then you don't need to have held them for 5 years. You need to have held them for 2 years if you want to get on business asset disposal relief, assuming that you qualify in terms of percentages, but you definitely don't need to have had them for 5 years. So that is an advantage. Obviously, the disadvantage there is that you've got to find another shareholder to buy the shares, which isn't always straightforward. So thank you for that question. Okay, so what about share options? Unapproved share options don't really offer you any advantages in terms of the tax treatment, because if you've got an unapproved share option, you simply get a tax charge when that option is exercised. And again, the tax charge is going to be based on the difference between the price that you pay and the market value of the shares. The advantage that we get with unapproved share options is that you can delay the payment of the tax until the point at which you have some money to pay it. So unapproved share options don't tend to be used for succession planning. Unapproved share options tend to be used where you want employees to participate in the sale of the company, but you don't want them to be a shareholder beforehand. So you give them exit link to unapproved share options, whereby if the company is ever sold, they can exercise their option, they can get their shares and they can sell them. The whole of the market value would be subject to income tax, so it's not terribly tax effective, but they're still getting a lump of money. So as I say, unapproved share options don't tend to be used where we have got succession planning type ideas. What you would normally use is an approved share scheme where there is a tax advantage and you allow your employee to become a shareholder over a period of time. Now, company share option plans, save as you earn share option plans, share incentive plans don't typically get enough value into the hands of people to really be terribly helpful from a succession planning perspective. So EMI is probably the one that we see most often, and so that's the one I'm going to look at. There are a lot of conditions, and we need to look at those conditions. Obviously, I haven't updated this slide. It should say confers BADR advantages. So with EMI, when you're looking at the tax charge, EMI looks at the difference between the price that you pay and the market value at the date the option was granted, sorry, not at the date that the option was exercised. So if you issue share options for a strike price of £1, so the employee has to pay £1 for the shares, and they're worth £1.50 when the option is granted and £5 when the option is exercised. When the option is exercised, they pay tax on 50p per share, because that's the difference between, rather than £4 per share, which is what they would pay if it was an unapproved share option. The BADR advantages that we have are that the 2-year holding period for BADR starts when the option is granted, not when it's exercised. So if you have held a share option, an EMI option, for more than 2 years, you can exercise it and then get full BADR. So qualifying option, it's got to be issued for commercial reasons to retain and recruit employees. Can't be for the avoidance of tax. You can't have more than £250,000 worth of unexercised options per employee. The maximum value per company is £3 million. They've got to be non-redeemable shares, exercisable within 10 years. There's got to be a written agreement, and the option can't be transferable. So I think the advantage of EMI, if you're talking about succession planning, would be that you give your employees some share options. You allow them to be exercised in maybe 3 years' time. That 3 years, you get them a little bit more involved in the running of the business. You perhaps put some performance criteria into the EMI, which you want them to meet. After 3 years, when you're pretty happy that they are a possibility from a succession planning perspective, you allow them to exercise the option. And then you perhaps think about how you would perhaps allow them to help you run the company for a little while. And then you start to think about how you are going to get rid of your shares, possibly by doing something like a purchase of own shares. Qualifying company, it can't be under the control of any other company. All of its subsidiaries have got to be at least 75% subsidiaries. It can't have value of more than £30 million. Must exist wholly for a qualifying trade. And this is the problem that you've got with EMI, is that it doesn't apply to all businesses. So a good example is accountancy. That is not straightforward. Qualifying trade is one which is run on a commercial basis with a view to profit and doesn't include any excluded activities. So things like property development, financial services, accountancy, legal, all of those kind of things, care homes, hotels, they are not qualifying activities. The individual's got to be an employee of the company working 25 hours or more a week, or at least 75% of their time, and they can't have a material interest in the company, which is more than 30%. And I think we have already covered the income tax requirements. So yes, I mean, I think that using employees as for the purposes of succession planning is really, really difficult. Because as I say, unless you have been grooming somebody for many years, particularly in owner-managed businesses, it is really not something that necessarily works terribly well. Now, in 2013, we had an idea which was supposed to try and encourage employee share ownership. Now, George Osborne, who was Chancellor of the Exchequer at the time, the well-loved and often missed George Osborne, was slightly obsessed with the John Lewis method of business ownership, where, of course, John Lewis is a partnership which is owned primarily by the real owners, but where if you are a partner, if you are an employee or a partner, you get a share of the profit that is generated by the business. Now, what we ended up with, which is employee share ownership trusts, ESOPs, doesn't really have anything to do with the John Lewis method of ownership, but the idea is kind of built on that. So the idea is that you transfer the whole of your business into trust, and that trust is owned for the benefit of all of your employees. So if you do that, effectively, there is CGT holdover relief for the business proprietor going into the structure. And it is also an exempt transfer for IHT purposes. So your benevolence means that you don't have any tax to pay initially, and it is not ever going to be brought into your estate from a tax perspective for IHT. So it's no gain, no loss, no IHT. And everyone's happy. Now, from the perspective of your employees, they don't really own the business. The trust owns the business. They can get up to £3,600 of bonus payments, which are tax-free. So whilst they don't have any capital value, they do have an ability to earn a small amount every year out of the trust without there being any tax to pay. But they don't own the company. So there are a number of conditions. So the person making the disposal can't be a company, so it can only be an individual. They must make a claim, and they must then satisfy what is called the limited participation requirement, and there can't be any related disposals. Now, the limited participation requirement is either that after the transaction, the claimant has no shares in the company at all, or that they don't have, or what the legislation describes as the participator fraction doesn't exceed 40% or 2/5. So the participator fraction is basically the number of people who still own shares divided by the number of shareholders, with the denominator being the number of employees in the company. So you can retain shares, but there are limits on that. You must be a trading company. Shares must be part of the ordinary share capital, and effectively it must satisfy what is called the all-employee requirement, which is basically held for the benefit of all employees on the same terms. And there is then a provision called the controlling interest requirement. And details are in your notes if you're interested in this. Question has been asked, what with an ESOT, what happens when the ESOT sells the business eventually? Are the proceeds distributed amongst the remaining employees? And what are the tax implications? That is a really interesting question. And do you know what? I do not know the answer to that question, because I've got a feeling that I've never looked at that far, because I've gone, just to put this into context, I've gone down the road of talking to people about ESOTs, but I've never got as far as actually putting one of them in place, because often they just don't meet the requirements. Let me just have a quick look and see if I can find the answer to that question. Because it is a normal discretionary trust. So presumably, if it is a normal discretionary trust, then if the, I think there's definitely a CGT charge in the ESOT, and it would have acquired the shares on a no gain, no loss basis. And I think because it is a normal discretionary trust, there would be tax paid on the payout, because I don't think that there is any specific exemption. And in fact, somebody's saying that there's a CGT in the ESOT and then there's tax on the payout. So presumably if it's a normal discretionary trust, there is going to be either an exit charge, though it might be an exempt trust. Anyway, I think that there would be a tax charge. Definitely the ESOT is going to pay tax on paying the business. There is no exemption for the ESOT in relation to that. So yeah, I think that that would be the case. But it is an interesting point, and possibly one that I should have thought about. But I've just never thought about that. Let me just have a look and see if I can see anything. No, I can't quickly see the answer to that question, but yes, there would definitely be a tax charge in the ESOT. And one of the participants has said that they have used both EBTs and employee ownership trusts for cash extraction. So yeah, that is a good point. It's just not something that I have ever actually managed to do. So it's clear that it has it does have a role, and there are one or two quite big businesses that have transferred their business to an employee ownership trust. Richer Sounds, the hi-fi people, hi-fi, that's such an old-fashioned word, isn't it? But Richer Sounds is now held by employee ownership trust. So yeah, it has been done. It's just not something that I've been involved in personally, so I do apologise for that. I think, sorry, I just got slightly distracted with answering those questions, though. As I've said, I'm always more than happy to take questions. I think one of the reasons that it is not something that people necessarily want to get involved in is because it's who drives that company forward. If you don't have somebody who is nominally going to take over the business, and again, I would fully acknowledge that it may well be that there is going to be nobody who's got the nous to do that. But I think there is that problem that effectively you have no one person who drives the business forward. And I think that is often why it's seen as a problem, but it obviously works in some cases. And then we have the final bit, and again, we have, you may go down the road where you look for a successor, within the family, you look for a successor within the employees, and then you have to reluctantly just realise that actually it's not going to work, and that the best thing that you can do is sell the company and move on. And, you know, again, selling and reinvesting the money, big issue in that situation may well be loss of BPR. And so often, if you're talking about selling as an alternative to succession planning, actually what you need to do as well is kind of look at IHT planning generally as part of the same thing. Obviously, the big issue when we're selling is going to be achieving BADR. You have a 10% limit up to £1 million. Looking typically at share sales. It needs to be the individual's personal company. It needs to be a trading company, and you need to be an officer or an employee, and those conditions need to be met for 2 years. And that would be 2 years up to the date of disposal if you are selling it, or up to the date of cessation if you're actually going to be winding up. Because again, the other thing that you have to acknowledge is that sometimes businesses just are not saleable. So personal company, again, most people will be familiar with this, I'm sure, is that somebody has to have 5% of the voting rights and 5% of the ordinary share capital. And since 2018, there has been a capital and income condition as well, meaning that you have to have an entitlement to 5% of the income or 5% of the assets available for distribution on a winding up, or as an alternative to those two tests, and be entitled to 5% of the proceeds on sale. Trading company we've already talked about, and you know, obviously the issues that we have with cash are equally valid from the perspective of a business asset disposal relief as well. Officer or an employee is a fairly straightforward one. If you are disposing of property outside of a company, again, there are more complicated rules. You've got to be selling at the same time as you're selling the shares, and you do have to take account of things like rent being paid, or periods when you know, other usage has been made of the actual property. So again, is not entirely straightforward. If somebody is selling a company or winding it up, then obviously business asset disposal relief is going to be very important, although with the reduction in the lifetime limit from £10 million to £1 million, there is a reduction in the businesses that will achieve it. Though I think at the time, they did say that 95% of business sales would still qualify for BADR. I'm not sure I necessarily would say that that's true, but possibly in the OMB market that is true. If you can't sell the company, then you might be looking at winding up. And I think with winding up of businesses, then the main issue is going to be making sure that the targeted anti-avoidance provision doesn't apply, which is where you wind up your company and get your value out as a capital distribution, but then you are continuing in the same business at some point in the 2 years afterwards. In reality, I think most businesses, if we're talking about succession planning, we're probably talking about retirement. So the chances that people are going to want to continue in those activities is probably very rare, but is just something that we need to be aware of. Okay, well, we are slightly inside the session as it was suggested. I was supposed to be allowed to go on to 12 o'clock if I needed to, but I think that I've come to the end of the material there. So thank you very much for your time this morning. I hope that you found this useful. Thank you very much, and goodbye.